And with that, I'd like to welcome everyone to tonight's presentation, Social Security Explained. And we're happy to have with us Mark.Lange of the Society for Financial Awareness. You see all those acronyms after his name there. You're going to get some really good information tonight about the whole Social Security process, and you can make the most of it. So any questions that you have during the presentation, feel free to ask them in the chat. And then maybe at the end, we can open up the microphones for anybody who wants to ask a question that way. So with that, I'll turn things over to Mark.
Thank you, Mark. It's always nice to present for you guys. I am thoroughly thrilled to do the presentation on behalf of SOFA. I always like to tell people why we joined SOFA, the Society for Financial Awareness. It's a nonprofit located out of San Diego, California. We joined them about 4 years ago. And we did so because we wanted to find a way to give back to our network of people in our surrounding community. We had done a lot of work with charities, but based upon a lot of the questions that I get when I do these and other areas that I had done presentations, I always felt that if I could educate our community, it would be very, very helpful. And this area in particular is one that I can't tell you how many times I have people that come up with rather interesting thought processes, but they're not very accurate relative to how Social Security works. So let me say thank you again to Mark for having me in. For those of you who have been on any of my SOFA presentations in the past, I'm going to run through some of the typical things I do. First of all, thank you for joining me. We're going to provide you with an awful lot of valuable information tonight. I will feed you through a fire hose, as I often do. So if it's too much, feel free to reach out to me via email, which is mark.Lange@lpl.com. If you have individual questions, as part of our presentations for SOFA, we offer everybody that attends an hour free consultation. I encourage you to take advantage of it if you have questions. This way we can talk about your individual situations. This is SOFA. Our mission is really to end financial illiteracy across America, literally one community at a time. But I tell everybody before I get started, it's an education event only. I'm not here to sell product in any way, shape, or form. Occasionally on different presentations, I will use different products to illustrate points, but this is education only. If we were doing them live, we'd have you fill out evaluation forms, and we're in the process of figuring out how to add that to our presentation so you guys can give us feedback. I always appreciate that because it helps me to gear where the presentation should go as we move forward. So let's get started.
Hey, so Mark, if you want to email me that, I'd be happy to send it out to those.
Sure. I will do that after this evening and get it out to you, Mark.
Sure.
So these are the common questions that I get about Social Security all the time. When can I take Social Security? If I take it early, does it go up when I hit my full retirement age? I'm going to refer to full retirement age with an acronym of FRA for those of you that are out there. And everybody's FRA, or full retirement age, is a little different. It's based upon when you were born. How do I maximize the benefits for my spouse? That is a key question for people today, because most of Social Security planning is really designed around today for married people. How do you take and provide the greatest amount of benefits for your spouse? Because once one of the two of you passes, your spouse will have to choose to either keep their own Social Security benefits or the other spouse's benefits, but you only get one of the two, and you're going to try and take the higher one, obviously. Will this impact the other assets that I have? Not necessarily, but it could certainly impact it from a taxable standpoint. Is Social Security taxable? That's going to depend on how much Social Security you get. And how does Social Security actually work? Because so many people really don't understand how Social Security works. So Social Security started in 1935 in what's called the Social Security Act. It was established as social insurance to prevent poverty. It was established with a board of trustees for the Social Security Trust Fund, and it requires an annual trustees report to Congress on the status of those funds. The board's made up of the Treasury, Labor, and Health and Human Services Secretary, as well as the Commissioner of Social Security and 2 public representatives that are appointed by the President. Every single year, that trustees group provides a report to Congress to tell us what's the status of Social Security and how solvent it should or is. I say should or is, will be. In many instances, Social Security People think that there's this grand fund that sits out there. It's a general obligation, and it is funded how? The people who are receiving Social Security benefits today, they're getting them from the people who are paying them in today. There's no great savings account that people are putting it into. Essentially, whatever you're putting in as a worker today is going to someone receiving those benefits. Here's the 4 parts of OASDI, which is called Old Age Survivors and Disability Insurance. Basically, as you can see, I've highlighted the 2 yellow quadrants, which is retirement benefits and survivor benefits. Why? Those are the 2 key elements you're going to pay attention to. Trying to get disability benefits from Social Security is extremely difficult, and the lump sum death benefit of $255 that was instituted in 1935, as you can well imagine, doesn't go very far today. But those are the primary components of Social Security, or what we call OASDI. So how is it funded? It's funded through what's called FICA. I'm sure many of you see this on your paycheck. When you get it, you'll see a FICA deduction, which is the Federal Insurance Contributions Act, and it's based upon your wages. The maximum income that you can have that would still have FICA applied to it is $142,800. There's a great deal of discussion that element will be eliminated. Why? Social Security is dramatically underfunded, and I'll show you why as we get a little later in the presentation based upon some of the trustees' reports. So how many people are beneficiaries that receive Social Security? Well, as you can see, and this is a little old, this is based on 2018. It's going to expand fairly significantly when the new statistics come out. But roughly about 70 million people are receiving benefits from programs administered by Social Security. So as you can see, there's a sizable percentage of people in the United States that are receiving Social Security on an ongoing basis. How do you become eligible? Well, you become eligible based upon the credits that you earn. So as a worker, for every quarter that you earn $1,470 of gross income, you receive 1 credit. You have to accumulate 40 total credits over your lifetime in order to qualify for full retirement benefits. So if you're earning at least $58.80 a year, you'll get your 4 credits in that year. And after 10 years of that, you qualify for Social Security benefits in retirement. What is full retirement age, or what I call FRA? This is the age that an individual becomes eligible for full, unreduced benefits. And it depends on the year of your birth. So for those people who were born in 1960 or later, their full retirement age is 67, but they still have the ability to access reduced benefits as early as 62. And you'll see from one of the slides I'm going to show you that there's still a sizable amount of people that access Social Security at age 62. Why? In many instances, the primary reason that people will take Social Security early is they have a history of health problems within their family, or they have a reduction in force where they have lost their jobs, they didn't plan on having lost their job, and they need that income. So that's the primary reason that we see people starting it early. So let's look at when you reach your full retirement age. Well, for those of you born in between 1943 and 54, your full retirement age is 66. For every year thereafter, as you can see, 1955 on the left-hand side, 1956, 57, 58, 59, what do? They add an additional 2 months to that 66 for you to reach your full retirement age. And as I said before, those of you born in 1960 and later, your full retirement age is 67. And you can apply for your Social Security up to 4 months prior to your desired start date. So how are your Social Security benefit amounts calculated? Well, the benefit amount is known as what we call the PIA, or primary insurance amount. So the way that that's calculated is Social Security takes 90% of the first $996 of average monthly earnings. Then they'll take 32% of the average monthly earnings that are over the 996 up to 6,002, and then 15% of the average monthly earnings over 6,002. So as you can see, it's weighted towards whom? The lower income elements. Why? It was designed to prevent poverty. It was not designed to be the primary retirement account for people, yet that is what it has become. I had a quick discussion with Mark before we started tonight, and I don't have this piece in the slides, but approximately 39% of the people in the United States, Social Security is the only form of retirement income that they have. So you can imagine it'd be very difficult to live off of that as we go further along when you see some of those numbers. So I'm going to give you an example of how the benefit formula gets calculated. We'll use a baby boomer that was born in 1959, who turned 62 in 2022. They've earned the maximum Social Security earnings every single year since age 22. So their average indexed monthly earnings is $11,098. So let's apply that primary insurance amount formula. So we're going to take the 996 times 90%, you get 896.40. The difference between the 996 and the 6,002 is $5,006. You'll multiply that times 32%, and the difference between the 11,098, which was their average indexed monthly earnings, and that 6,002 was an additional 5,096, but they'll only get 15% of that, for a grand total of $3,262.70 as a monthly amount. And there's your annual amount from Social Security. So as you can see, people who have reached that Social Security maximum all the way along, and it's been indexed through the years, they can get a primary insurance amount of $3,262 a month at their full retirement age. And there could be some additional benefits depending upon how they access Social Security and when they access it. So this is the full retirement age chart, because so many times people will say to me, if I take it early, what happens? So in this particular illustration, I'm using 67 as the full retirement age. So the left-hand column is as early as you can possibly receive benefits. We start at age 62. But if your full retirement age is 67 and you decide to take your Social Security at age 62, you're only going to get 70% of your full retirement age benefits. And you can see the corresponding amounts in 6-month increments on all the way up to your full retirement age. And then you can see the corresponding spousal benefits and how much they would be reduced by as well. So what if you apply for early benefits? And in this instance, I compared full retirement age of 66 versus 67. And you can see if your full retirement age was 66 and you decide to apply at 62, you get an additional 5% over the full retirement age of 67. So as you can see, there's a fairly significant reduction in benefits for people who take it early. This slide is the key. And I say it's the key because it's important for people to understand this is based upon historical data. When do people typically claim Social Security? You can see almost a full third historically have taken their Social Security at age 62. Now, I have to be honest with you folks, this is changing rapidly, especially over the last 5 to 10 years. Over the last 5 to 10 years, we see that the vast majority of people who are either claiming their Social Security at their full retirement age, or they're postponing till age 70, and I'm going to show you why. So each additional year that you work and you decide to defer taking your Social Security, for those of you that were born in 1943 or later, you will get an additional 8% per year for every year that you delay all the way until age 70. So if your full retirement age was 66 and you delay until age 70, you get 67, 68, 69, and 70. You get 4 years, 4 times 8, you get a 32% increase in your benefits. Folks, at the bottom left of that slide, you can see application for Medicare is still recommended at age 65. If you delay, you could have not only an increase in the cost, but also additional penalties. So, again, a little quick chart. If your full retirement age is 66 and you delay to 70, you can see your benefit goes from 100% to 132%, or basically a third more by waiting those additional 4 years. And you can see the corresponding amounts for age 67 as well. So what's the key thing that I point out to everyone with this particular slide? Today, for most people, because defined benefit or what we call pension plans are pretty much gone, the primary source of guaranteed income for people in retirement is Social Security. The best way to enhance how much you'll receive is to wait and apply for Social Security till you're age 70 so you can accumulate some additional delayed credits. There is discussion out there about possibly either reducing or potentially even eliminating the delayed credits. There's also a great deal of discussion about pushing the maximum Social Security age from 70 to 72 or 75. We'll have to see how that legislation moves through, but I can promise you that seniors today, or those approaching that time frame in their life, are not going to be happy if they start to decrease those benefits. So let's look at what Social Security offers in terms of total income that, quite frankly, you can't outlive. And you can't outlive it because once you start receiving it, as long as you're alive, you'll continue to receive it. In this particular example, I'm assuming a 2.6 annual cost of living adjustment. Folks, that's been the historical average. But I'll tell you this, last year, it wasn't 2.6. You could basically flip that. It was actually over 6%. So you had an over 6% increase in your cost of living adjustment for Social Security. Here's the bad news. Your Medicare premiums went up substantially. So basically, all the additional dollars that you got in terms of the cost of living adjustment went where? Into expanded or increased premiums for Medicare. But as you can see, for those of you who have longevity that runs in your family, if you live for 30 years, you'll have basically pulled out $1.5 million in benefits based upon a $3,000 benefit today with those cost of living adjustments for 30 years. So fairly substantive for most people. Will it be there for me? This is a question that I get from almost everybody when I do these presentations. This is the trust fund balance as of the end of 2019. And as you can see, the total income was just over $1 trillion at 1.061. Total expenditures was 1.059 trillion. So they added a net increase of $2 billion. $2 billion isn't going to go very far when you've got 70 million people drawing on this fund. This is why. These are the long-term projections without any reforms to Social Security. The trustees report of 2018 indicated that roughly by the year 2034, benefits will have to get cut to approximately 79% of what they are today. So as I tell most people, it behooves you to wait as long as possible to take your Social Security benefits, and the enhanced benefits you would receive from those delayed credits, as you can see, may ultimately be removed because of the fact that Social Security is underfunded. And it's underfunded quite significantly. And the biggest problem that we have is that we have more people coming into the system starting to draw on Social Security. When Social Security was first established, you had 41 workers for every recipient. Today, it's less than 2 workers for every recipient. let me just make sure I didn't go too far. How do you get an estimate of your Social Security benefits? Because everybody asks me that. So you're going to go to www.ssa.gov for those of you who haven't done it, and you'll need to set up an account and prove who you are. What does this mean? Well, it means you're going to be asked questions, some of which you may not have a good memory of from years that have passed. And if you can't confirm the information, you get 2 tries, you're going to have to get down to the Social Security office to then set up your account. Most of you should probably ask the following question. How do you know that? Well, let me tell you. When I first tried to set up my account, they asked me a question about a car loan that I had when I was 18. Well, they listed 5 different financial institutions. There's just one problem. I had a car loan with 3 of those 5. So I chose one and it was incorrect. I chose another one and it was incorrect. And off I went to the Social Security office, which took me 3.5 hours to finally get registered with an account. So I tell people, please don't guess. Do your homework, go back to your records, make sure they're accurate. Otherwise, you can go visit the Social Security office just like I did, and you'll sit there for an extended period of time. It's not a lot of fun. So let's talk about some of the facts, because a lot of things have changed as a result of the legislation from 2015 when they really reconfigured Social Security dramatically. The primary worker must have filed for benefits for a spouse to apply for a spousal benefit. Please don't forget that. There's very few people who would qualify under the old rules because you'd have to be quite a bit older and way beyond when most people would be applying for Social Security to take advantage of the old grandfathered rules. So for virtually everyone today, that first statement is critical. Primary worker must have filed for benefits for a spouse to apply for a spousal benefit. If you're entitled to a spousal benefit and your own benefit, you are deemed to be filing for both of them. The spouse must be at least 62 to apply for reduced benefits or 66 for full benefits today. Only those who are age 62 in 2015 can use the grandfathered restricted application. Very few have that available to them today. No delayed credits on spousal benefits, however, after 66. And then file and suspend, that loophole that used to be out there was closed in 2016. So it's really changed the complexion of Social Security dramatically from what it was just a few years back. I'd be remiss if I didn't talk about Medicare. Many of those who take early benefits forget to apply for Medicare. Why? Because they aren't reminded that this benefit doesn't start till 65. So if you delay your Social Security till age 70, please don't forget to apply for Medicare when you reach age 65. If you defer your Social Security and you do not have company insurance, you can apply 3 months prior to your 65th birthday. Because you're not enrolled in Social Security, you will not automatically be enrolled in Medicare. Folks, it is very important that you pay attention to these components. And if you apply for Social Security after turning 65, you have a 7-month Medicare enrollment window. If you don't make that, you're entitled to enroll in the general enrollment from January 1st through March the 31st of the following year. However, benefits won't begin until July, and you could be subjected to a 10% penalty to the Part B premiums for each year you fail to sign up. So if you had a full retirement age of 66 and you waited till age 70 to do it, you will have 5 years worth of penalty. You could have potentially a 50% increase in your Medicare premiums. So very important to pay attention to that stuff. Who's eligible for survivor benefits? And I always like to talk about this particular area because one of the things that people don't realize is survivor benefits become one of the key elements for people when one of the spouses has passed away. So it's very important for people to pay attention. Let's look at what these rules for spousal benefits are. In order for the spousal benefit to be paid out, the other spouse must have filed for their own benefits. You have to be at least 62 for reduced benefits or full retirement age for your full benefit. If you're choosing the spousal benefit, you can get 50% of the PIA of the primary person who's applying for benefits. As I said, there's no delayed credits on the spousal benefits after FRA, and spousal benefits based on the worker's primary insurance amount, not the actual benefit. And there is a marriage requirement of 1 year. Now, for many people, they don't realize that multiple spouses can also apply for benefits under one individual, what I'll call the Johnny Carson rule. Johnny Carson was married 3 times, and in each instance, he was married for at least 10 years. So each of his spouses have applied to get his Social Security primary insurance amount as a spousal benefit. So you have 3 spouses that are collecting off of his PIA. So let's look at this example. In this example, John has a primary insurance amount of $2,000. Jane has a primary insurance amount of $800. If Jane applies at full retirement age, her benefit's going to be $1,000. $800 of it will be her benefit, and $200 of it will be the additional dollars to fulfill the requirement to get to 50% as a spousal benefit. If the spouse applies for before full retirement age, it's going to be reduced. So here again, you can see, and again, I've got 43 to 54 and then 1960 and beyond. You can see there's a dramatic reduction in that spousal benefit if you decide to take it early. What are the rules for survivor benefits? And folks, this is the critical area for those of you that are married. Couples must have been married for at least 9 months at the date of death, except for in the case of an accident. The survivor has to be at least 60 for reduced benefits, 50 if they're disabled, or full retirement age for full benefit. The survivor benefit is not available if the widow remarries before age 60, unless the marriage ends. That's why you see so many seniors cohabitate once they receive Social Security benefits. Why? They don't want to give up one of those benefits. And divorced spouse survivor benefits are available if the marriage lasted at least 10 years. Again, what I call the Johnny Carson benefit. These are the survivor benefits if you apply and you decide to do so for reduced benefits. I'm not going to go through these because I'm just going to plain and simply confuse everybody by doing that. But the important thing for you to remember here is, let's say that we have a non-working spouse and we have a primary insurance amount on the primary of, say, $3,000 a month. So now the non-working spouse is receiving $1,500 a month. If that individual who's the primary passes away, that surviving spouse is going to have to make a choice. Do they want to keep their $1,500 a month spousal benefit, or do they want to choose to give that up and take the $3,000 a month benefit of the primary? That's available to you, but you're going to have to choose one of the two. So in this example, we're going to use Joe and Julie. They're married. They're both over full retirement age. Joe's benefit's $2,000. Julie's is $1,200. Joe passes away. Julie notifies Social Security, and her $1,200 benefit is replaced by her $2,000 survivor benefit. So very important to understand those advantages. That's why in many instances, it makes sense for you to run a Social Security comparison. We do it all the time for our clients and for people who have gone through the SOFA events, where we will show them how to maximize their Social Security benefits between the two spouses. Very important to try and do that. Survivor benefits example, if you do early claiming, again, we'll use the same example. Joe and Julie are married. Joe's PIA is 2,000. Joe files for Social Security at 62. So his benefit's going to be reduced. He's only going to get 75% of that, or $1,500. If he dies, Julie's survivor benefit's going to depend on when she claims it. And here you're going to get into one of the really wacky parts of Social Security. You can see if Julie claims her survivor benefit at 66, which was her full retirement age or later, her benefit will be 82.5% of Joe's 2,000, or $1,650. This is a special floor for survivor benefits. If Julie claims her survivor benefit at age 60, before her full retirement age, her benefits are going to get cut, and cut fairly significant. So the key part is down the bottom. The amount that the survivor actually receives depends both on when the deceased spouse filed for benefits and when the surviving spouse filed for the survivor benefit. So as you can see, Social Security is not really straightforward in many instances. There's a lot of unique elements to it. If you're not sure what they are, get with somebody who understands how to take you through those calculations and can help you to determine how to maximize those benefits. So again, we're going to use a survivor benefits example, but in this instance, we're going to delay the claiming. So again, we're going to use Joe and Julie, married. Joe's primary insurance amounts $2,000. Joe files for Social Security at age 70. So he's delayed taking his benefit to the maximum, which is age 70. So he's going to get a 32% increase in his benefit. So he's going to go from $2,000 to $2,640. If he passes away, if Julie claims her survivor benefit at age 60, again, she's going to get a reduced benefit. But if she's reached her full retirement age or later, she's going to be able to collect those additional accrued benefits that Joe qualified for by waiting till age 70. She'd be able to get the $2,640. So this is why it's so important for spouses to discuss this and make good decisions about when to take Social Security. Are non-workers eligible for survivor benefits? Absolutely. If their marriages have lasted at least 10 years, a non-working spouse is entitled to survivor benefits. And so are widows and unmarried children, as well as dependent parents. I won't get into all the unique aspects in those areas. There's about 57 different unique aspects that we could go through, in which case you guys would be here a lot longer than the hour that we've allocated for tonight. So are non-workers eligible for survivor benefits? Well, widowed individuals are eligible for unreduced benefits at full retirement age, reduced benefits at age 60 or 50 if they're disabled. Widowed individuals supporting children younger than 16 years of age or disabled are eligible. Unmarried children younger than 18 or 19 for full-time students are eligible. And if the deceased worker provided more than 50% of the support for the worker's parents, they're eligible at 62 years of age. So as you can see, there's a lot of different ways to access the tentacles of Social Security. In fact, there's over 122 different ways to access it. What are the rules for divorce spousal benefits? Well, more than one ex-spouse can receive benefits on the same worker's record. Benefits paid to one ex-spouse do not affect those paid to the worker, the current spouse, or other ex-spouses. And divorce spouse benefits stop upon remarriage of the spouse collecting benefits, not upon remarriage of the primary worker, only the divorced spousal benefits. The divorced spousal benefits are the same as spousal benefits as long as the marriage has lasted 10 years or more. A person receiving divorced spousal benefits is currently unmarried. Again, why I said that many seniors cohabitate once they've reached Social Security age and the other has passed away. The ex-spouse is at least 62, and if the divorce was more than 2 years ago, the ex-spouse does not need to have filed for benefits. That's one of the rare times that the primary individual does not have to apply for benefits, but it's only because of the fact that it's a divorced spouse in this instance. Another one of those unique loopholes for Social Security. How much of your benefits are going to be taxed? Well, that depends upon your filing, whether you're filing individually, married filing jointly, or married filing separately. Very important to pay attention to those things. So here's how it works. If you're an individual and you have combined income between 25 and 34,000, up to 50% of your benefits are taxable. If your combined income is more than 34,000 from different sources, up to 85% of your benefits are going to be taxable. Same parameters for a joint is between 32 and 44, with up to 50% of your benefits taxable. And if your combined income is more than 44,000, 85% of your benefits are going to be taxable. For most people living in the New York metropolitan area, they're going to fit under the joint situation. They're going to be well over $44,000. In fact, I have some clients that as they postpone their benefits to age 70, what we're finding is that their Social Security income alone is above the $44,000 threshold. For those of you who want to work, it's important to pay attention to this. Social Security benefit reduction. If you begin collecting before you've reached your full retirement age and you continue working, if your full retirement age is not reached during that entire year, they will deduct $1 of benefits for every $2 you earn above the annual limit. And it changes every year. It's not very high, folks. It's right around $15K. If your FRA is going to be reached in that year, they'll deduct $1 in benefits for every $3 that you earn, but only on the earnings before the month that your full retirement age is reached. And once you've reached your full retirement age, there's no limit on the earnings that you can make. They're not going to reduce your Social Security once you've reached your full retirement age. Some key things to consider. Only apply for one benefit at a time. Try not to file for both simultaneously. This way you can enhance the benefits that you receive over time. In most instances, it pays to compare your own benefit against a survivor benefit to determine the strategy that will generate the most money long term. So think in terms of the benefit for your survivor as well. In most instances, it's beneficial to take the lower earning spouse's benefit first and defer the higher earner's benefits until age 70. This strategy also locks in the biggest benefit for the surviving spouse. And lastly, could a Roth IRA impact how my Social Security is taxed? Absolutely. One of the things that you have to pay attention to is a thing called provisional income. Provisional income is all the sources of income that you have coming in. So any investment accounts, inclusive of tax-free bonds, as well as any earnings, plus your 1/2 of your Social Security goes into that provisional income calculation. The only thing that doesn't go into that is a Roth IRA distribution. So Roth distributions won't have an impact on provisional income. So there's some really key questions that a lot of people have to pay attention to. And the first key question is, when should I take Social Security? Well, it's really a personal decision, and it's based on what your needs are as well as your probable life expectancy. And folks, I would tell you there's some great websites out there. I think Google's got one of them that will give you the probability of your life expectancy based upon a number of different factors. Plug it in, because in many instances, people are going to live longer than they ever expected. Healthy individuals can typically delay benefits. Delaying benefits is likely to increase the future benefits for a much younger spouse as well. And typically, less healthy individuals will begin receiving their benefits earlier, as I discussed when we talked about taking an early Social Security benefit at age 62. So when we talk about retirement planning, it really comes down to 3 questions. Are you going to take your Social Security early? Are you going to wait till your full retirement age? Or are you going to wait till age 70, for example? Or you may say, my full retirement age is 66, but I'm going to wait till 68 because I plan on working 2 more years. So in that instance, you'd be delaying your Social Security. But those are really the 3 key questions with regards to Social Security. Here's a quick little take on it. And I've got 3 different ages. I'll use age 62, age 66, assuming that's a full retirement age, and age 70. So if you claim at age 62, here we're looking at a husband and wife. We'll assume that David is the higher of the primary insurance amounts. They would each have a reduction from that middle row. The middle row is the full retirement age. So at full retirement age, David would receive $2,000 a month. If Dana waits till her full retirement age as a spouse, even if she didn't work, she'd be entitled to a $1,000 a month benefit. If they take it early, you can see the corresponding decreases. If, however, they postpone and capture those delayed retirement credits, David would be up to $2,600 a month. The $1,300 a month would be available on the delayed credit because David waited till age 70. And also that would be available as a survivorship benefit in the event that one of the two were to pass away as well. So what are the next steps for you? First of all, I tell everybody, get familiar with the Social Security statement. It's available online at www.ssa.gov/my-account. Number 2, understand how the primary insurance amount is impacted by earlier delayed retirement, earned income, and taxes. For some people, you have to have, what will happen is your primary insurance amount is based upon your 35 highest years of earnings. If you don't have 35 years of earnings and you have some gaps, for example, if you were younger, you may have had a couple of years where you had 0, it may behoove you to add a year or 2 at the end so that you increase your primary insurance amount. Third, consider financial products such as annuities to help bridge the gap. That last designation on the first slide, RICP, is Retirement Income Certified Planner. One of the biggest issues that we talk to retirees about today is expanding the amount of guaranteed income that they have. So frankly, for those people who have pensions, and that's many public employees, many times we'll see a husband and a wife both with a pension, and they'll also have Social Security as well. So for those folks, they've got 4 sources of guaranteed income. For those people who don't have defined benefit programs, in many instances, you'll only have 2, and those only 2 will be Social Security. So what we want to do is enhance the amount of fixed or guaranteed retirement income. Why? Because when you go through periods of time like the market's in today, you're very happy when you have guaranteed income coming in that will not be fluctuating based upon what's happening in the marketplace. And if you're not sure where to go or what to do, contact a competent financial advisor and determine the optimal strategy for allocating assets and receiving Social Security. That's the end. Normally, I would ask you for evaluation sheets, but at this point, I'm going to open it up to any questions. So feel free to go to the left side of that lovely Zoom toggle bar. You can unmute yourself if you'd like to ask any questions.
Or feel free to type in the chat. Mark, can you put your contact info in the chat?
Sure.
Great.
Put it up in here. Pretty simple. It's mark.Lange at lpl.com. I am a registered representative with LPL Financial. We are the largest independent broker-dealer in the country. And I'm also a member of WealthCare's advisory team, where I operate as a registered investment advisor as well. So for full disclosure, those are the 2 components that I work with outside of SOFA.
I don't see or hear any questions.
I think I've mesmerized you.
Thank you. No questions, somebody says. Okay.
You're very welcome. Well, thank you all for joining me. Mark, thank you once again for putting this on. It's always a pleasure to come in and talk to your people. And I look forward to some of our future events. I know one of the things we talked about ahead of time was a piece called Investing in a Fragile Market. It's something that's very popular at the moment, and I'm doing that particular presentation 16 times this month.
Woo-hoo.
So yeah, we have quite a few libraries that that is number one on the docket. So I look forward to seeing all of you again when we get a chance to do those.
All right. Thank you so much, Mark.
Thank you. I wish you all good night.
Good night, everybody.